Are you intending to help your kids financially in the future? Cost of living has drastically increased over the past 5 years by more than 20%, making it harder and more difficult than ever to actually start off financially on the right foot going forward for a lot of these 20 to 30 to 40-year-old generations. We've had countless clients come through our door over the last 10, 15 years with the goal of passing on wealth to the next generation, whether it's their kids or their grandkids, and they're not exactly sure on the best way to do it. So today in this video, we're going to walk through some do's and don'ts when it comes to passing on inheritance, passing on wealth to the next generation to actually benefit them versus hindering their financial perspective, their financial capabilities going forward. In this video, we're going to discuss the concept of early inheritance and basically some do's and don'ts and some errors that could be made if you were to pass it on in a non-beneficial way. When receiving amount of money at any stage of life is often welcomed, there's typically one error that we see reoccurring, and that's usually when it comes in the amount of a smaller inheritance because it's not utilized in a beneficial way. It's not utilized in the best option for that individual to actually benefit themselves, benefit their kids, and put them in the next best step for their finances leading up to retirement or leading up to whatever goals they have in finance. Realistically, it's all too common to see those small inheritance amounts just simply being spent instead of utilized for or planned for your future. We're going to look at how to best use these funds and actually build a legacy, actually help future generations, not just on the short term, but actually long-term effects and how we can build this to create, again, a lasting legacy with your name. We're going to look at 4 key pros when it comes to early inheritance. So the first one being is financial stability. The second one being debt management. The third one being business opportunities. And then finally, we're going to look at education potentials. So let's start by looking at financial stability. An early inheritance can provide great stability for the younger generation to help them start off well, start off strong in their own personal finances. This is particularly important for the young adults who might be struggling when it comes to their own finances and how to actually fund their life based off of the growing inflation and the slower growing wages that we're seeing in such a common kind of market today. With the cost of living growing so much faster than what wages currently are, or what your income sources are, it's becoming, again, ever more so difficult to actually start off on the right foot and to actually reach those goals that you might have had, your kids might have the intention of receiving, or the goals that you previously had set out for yourselves. They're going to find it quite a bit more difficult just based off of what the current economic scope is, again, regarding that inflation rising and wages not meeting that same standard. Now let's look at debt management and how these early inheritance amounts can help that debt management. So let's start off with the high interest debts. Those are great to be paid down with those inheritance amounts, whether it's, we've got credit cards, student loans, line of credits, anything that is a higher interest than anywhere you could receive a rate of return on. You're going to want to be paying those down. And by receiving those inheritance amounts and directing them towards that is smart planning, that is smart financial future protection going forward. You're not going to want to be using those funds elsewhere. Let's start by paying those down. These debt management tactics are going to really jumpstart your financial stability going forward. By eliminating these debts, you're giving your children an opportunity to now not pay all those interest payments on a month-to-month basis, but they're now going to be able to use those funds and save them into their own retirement funds, education funds, funds for their children. They're going to be able to utilize that versus just paying it back to the bank in the form of interest, which is never what we're wanting to see. Again, paying off those debts and ongoing expenses, we're able then to redirect those funds to savings accounts going forward. And then once those interest expenses are no more, we're able to direct those funds to, your emergency fund, to savings accounts, to retirement funds. All of those are great next options. Now let's look at the third opportunity that an early inheritance can provide, and that is the business opportunity aspect, meaning that by receiving this early inheritance, you're able then to direct it towards a new business opportunity, or you could be buying a stake in a company, or even starting your own company. This is going to give you the opportunity to jumpstart your finances, to exponentially grow your annual income, to get you to a point where you're able to then save more as well, retire earlier, or even pass on wealth to those next generations down the road. By helping your children build their successful career through these inheritance amounts in the form of purchasing business or buying a book off of a certain professional, this is going to help them build their legacy, which also in kind helps you build your legacy through them. And then finally, the last pro I want to look at is the education side, is basically meaning that those funds can be directed towards an account that's utilized for education, or just simply paying off tuition expenses, where they're able to increase their knowledge, increase their expertise in an area, which will provide a greater income opportunity in the future. So this can either be towards your kids, towards grandkids, giving them the opportunity to jumpstart their professional careers in order to help them build up their financial kind of portfolio in the future. So let's look at the biggest con, or the biggest error that we see when it comes to these amounts, and that is mismanaged funds. Often you aren't going to see a lot of smart financial decisions about receiving funds on an annual basis, because it's going to be directed towards unneeded expenses, such as vacations, or just simply spending more on an annual basis because they have this stream of income. It's not going to be a wise decision to be doing that, but this is something we often see as a result of those smaller ongoing annual inheritance amounts that are pretty common and pretty preferred by a lot of parents when it comes to passing on wealth to their kids or to their grandkids. Additionally, these mismanaged funds can then provide a false sense of security, meaning that they're going to start living a more lavish lifestyle that probably isn't sustainable going forward or going into the future, and they're eventually going to hit a point where they realize they are spending way more than their means allow them to, as a result of not receiving that inheritance anymore, because that will eventually stop. So without just providing you a con, I want to provide a solution as well to this, and that is don't pass on smaller inheritance amounts. My suggestion is pass on larger sums. And the reason for this is, first off, you have more say on where this is going. You can be the smarter, wiser person in this situation to suggest where those funds should be directed to, whether it's paying down debt or paying off their mortgage or helping them with a down payment, something that is going to help them not currently in their current financial situation, but it's going to help them get to the point where they're meeting their goals faster and they're budgeting smarter and they're able to save more because they aren't paying down high interest debts. So again, with those larger amounts, then it's probably easier to direct those towards purchasing or buying into a business, or paying down on your mortgage, or even having a larger down payment to allow for a greater home purchase as well. These are all great options as a result of these larger inheritance amounts versus these smaller annual incremental amounts. Now, with these larger amounts, there needs to be more planning and processing when it comes to when to pass these on, how much to pass these, or how much we're going to be passing on, and the frequency of it. So you need to actually sit down with your child, or sit down with whoever you're passing this wealth on to, and have a clear, concise communication with them. Have that conversation of where you'd like to see those funds go to, have them recognize that this isn't going to be an ongoing thing, so they aren't going to just assume that they're receiving this wealth ongoing, but they're actually then able to direct it towards something that would be very wise to, very financially beneficial to. So today we're going to look at 3 scenarios on our planning software, and it's basically the concept of we have Mr. and Mrs. Young. They are both 30 years old and they're receiving some funds from her parents. So it's either going to be a no inheritance scenario, a small incremental annual inheritance scenario, or a larger amount that isn't necessarily known to this couple, but they're receiving it, and then we can kind of see how your mindset changes based off these larger sums. This is not an actual client, but this is a scenario that we've seen very often occur as a result of these inheritance amounts. So this is a real life setting. This is something that we do see quite often in our office here. So I hope you're able to actually find the benefit of seeing this and seeing how it's played out in other individuals' lives over the course of the past 10, 15 years. So let's just jump into it. So jumping into this scenario, we've got Mr. and Mrs. Young. We've got $162,000 of household income that is split between the two of them, and we're going to see this grow over time with inflation as well. They have a current investment portfolio of $355,000 across their RSPs, their TFSAs, and their emergency fund. And they have a home ownership of $800,000 and a $450,000 mortgage attached to that. So this first scenario we're going to look at today is no inheritance. So we're going to see that there's consistent spending of $78,000, as you can see on that left side, which includes budgeting for all of their annual expenses. So keep in mind, we haven't included any larger expenses which would then need to be budgeted for through this cash flow, such as vehicle purchases every handful of years, any trips that they're taking, any expenses for their children. All of that would need to come out of that annual amount that we have budgeted for them going forward. So when we jump in here, you can see that we have Mr. Young. He's got $96,000 on an annual basis, growing with inflation. And he's able to save into his RSP, and then with the tax return, we have some of that going back into his TFSA. Additionally, we have him paying down his half of the mortgage going forward. Now we have here Mrs. Young. She has $66,000 of annual income. Again, this is growing with inflation there. She is not contributing quite as much to her RSP, and she also is paying down half of the mortgage ongoing as well. So I slightly touched on that they have children. So they've got 3 children, and we don't actually have the ability to save for their child's education based off of what their spending needs are, based off of what their retirement goals are. This doesn't allow them a lot of flexibility when it comes to saving for their children's education through an RESP. At the end of the day, we've projected until Mr. Young is 60 years old, and at that time, so at retirement, they have $3.7 million of assets allocated for spending, then which is equivalent to $2.1 million in today's dollars. Now we're going to look at an ongoing $10,000 a year inheritance. So Mr. and Mrs. Young begin receiving an annual inheritance of $10,000 from her parents, growing slightly every 5 years. So one benefit or one smart decision they decide to do is contribute to their girls' education savings. So they've decided to start contributing to their girls' education savings. So we've got $2,500 into Malia, $2,500 into Jenna's, and $2,500 into Grace. And that is going to go until those girls are at post-secondary, where they need to then withdraw funds from the account. Additional funds aren't utilized to benefit their financial situation. Instead, they decided to increase their spending. So we went from $78,000 a year now to $83,500. Because they're receiving this annual amount, they're then choosingly or without knowing they're spending it more on an annual basis, which isn't going to benefit them in the long run. This is all too common. Occasionally, we don't even see any steps to take the right savings decision into account. Often, it's all directed towards just additional annual spending. As they get older, they may realize this isn't beneficial and they're spending above their needs, but it's become all too normal at that point, and they're confident that cash will just keep coming from the parents, and they do not need to worry about that ever stopping. So with retirement at 60, same as the previous scenario, they have now saved more for their girls. They've also spent more on an annual basis, meaning that they haven't increased their savings, and their retirement funds are still at 3.7 million of assets allocated for spending then, which is 2.1 million in today's dollars. Now, this final plan option I want to look at today is the lump sum inheritance. And basically, Mr. and Mrs. Young receive 3 large lump sum amounts from her parents, and they are valued at $93,500 each. So thanks to this cash influx, they're more confident with savings for the kids' education, so they're still doing the same savings as in the previous plan. Since the inheritance amounts are not known and timing is sporadic, they haven't increased their spending, which is often what we'll see as a result of larger inheritance amounts versus these smaller incremental amounts. The last inheritance received, they're in their 50s with no mortgage remaining to pay down, but now they know that it's better utilized for retirement savings. So let's just jump into Mr. Young here. And you can see that we've got half the inheritance amount there on his side and half will be over on Mrs. Young. So as we scroll down here, as you can see on this right side here, this inheritance amount has then been directed towards paying down their mortgage, which is going to decrease their debt, decrease their interest expenses, and benefit them going forward. With retirement at 60, as you can see in the bottom right corner, they now have 4.15 million of assets allocated for spending, then which is equivalent to 2.35 million in today's dollars. So we've gone from receiving annual amounts of 10,000 to an equivalent lump sum portion of 3 lump sums over their lifetime, and we're still saving the same amount for their kids. And instead of spending more on an annual basis, we're able to increase the amount that they have later in life, which can then be utilized for retirement. Now, with these additional funds, this may allow them to retire earlier, spend more in retirement, or follow the same path you did and pass on wealth to the next generation or the generation thereafter, which is the whole focus, because we want to look at building a lasting legacy. We want to look at building generational wealth going forward.